Hey everyone, welcome back to Corporate Decoder, the place where we untangle the financial webs of big companies, and boy do we have a juicy one for you today. Get ready because we're diving into JAKKS Pacific's latest report, and let's just say things are looking interesting. Before we dig in, if you love getting the real story behind these corporate filings, make sure you're subscribed. And hey, if you want to chat about these numbers and get even more exclusive insights, join our Discord community. The link is waiting for you in the description below. Alright, let's get straight to the numbers. Total assets for JAKKS Pacific stand at a little over $438 million. That's down slightly from over 440. This gives us a rough idea of their financial health at a glance. Now let's talk about the company's cash. They have about 38 million in cash and cash equivalents right now. That's a pretty significant drop from nearly 70 million at the end of last year. They also have almost 5 million in restricted cash, which is money they can't freely use. This decrease in cash makes you wonder where it all went. Digging deeper into their assets, inventory is up to over 71 million from just over 52 million at the end of last year. This could mean they're stocking up for future sales, or perhaps they have products that aren't moving as quickly as they'd like. It's a bit of a mixed signal. Increased inventory can be good if sales pick up, but it can also tie up a lot of money. Looking at their liabilities, accounts payable jumped to over 65 million, way up from about 42 million. This means they owe a lot more money to their suppliers right now. It could be normal business practice, but a big jump like this often means they're stretching out payments, which can sometimes signal a pinch in cash flow. Now for the big picture of how they're doing, their profit and loss. For the 3 months ending June 30, 2025, they actually reported a net loss of about $2.3 million. This isn't great, especially when you compare it to the same period last year when they made over $5 million. Let's look at sales. Pod net sales for the quarter were about $119 million, which is a pretty big drop from over $148 million in the same quarter last year. That's a decrease of about 20%. Imagine losing 1 out of every 5 customers. That's the kind of impact a sales drop like this could have. Their cost of goods sold also went down, but not as fast as sales. This means their profit margin, how much money they keep after paying for the products, has shrunk. For their toys consumer product segment, sales dropped by over 23%, while the cost of sales only dropped by about 21%. That smaller percentage drop in cost means they're keeping less money for every dollar of sales. And get this, even though sales went down, their selling, general and administrative expenses actually went up by about $2.9 million. So they spent more money on things like marketing and operations while bringing in less money from sales. That's like running a marathon and having to carry extra weight. All of this led to a loss from operations of about $2.8 million for the quarter. A year ago, they were actually making over $7 million from their operations. That's a huge swing, showing a significant shift in their profitability. Looking at the first half of the year, their toys consumer product segment sales stayed pretty flat, up just about 0.2%, but their costumes segment sales dropped by over 13%. So while one part of the business is holding steady, the other is really struggling. Interestingly, for the toys consumer product segment, the cost of sales as a percentage of sales actually improved. This suggests they might be managing their product cost better in that area, or perhaps selling more of their higher margin items. However, just like in the quarter, their selling, general and administrative expenses for the 6 months increased by about $233 million. This is happening while net sales for the first half of the year also declined slightly. This pattern of rising expenses alongside falling or flat sales is definitely something to watch. Let's shift gears and look at the balance sheet again. JAKKS Pacific's total stockholders' equity is around $236 million. This represents the owner's stake in the company after all debts are paid. It's down from about $240 million at the end of last year. This decrease likely reflects the net losses they've incurred. Speaking of losses, for the 6 months ended June 30, 2025, they reported a net loss of $4.7 million. Last year, for the same period, the net loss was even bigger, almost $9 million. So while they're still losing money, the situation has gotten slightly better. Now, their credit facilities, they've recently entered into a new senior secured revolving credit facility with BMO Bank NA, which provides them with up to $70 million. This is a good sign that they can access funds if needed. As of the end of June 2025, they hadn't borrowed anything from this new line, which is a positive. For liquidity, their working capital decreased to about 109 million from 119 million. This is mainly due to cash being used in financing activities. They also have significant future minimum royalty guarantees over $63 million, with about 48 million due in the next year. This is a substantial obligation that will impact their cash flow. The report also mentions that there have been no material changes to the risk factors they disclosed previously. This means all the regular risks associated with their business, like market competition, reliance on key customers, and economic conditions, are still very much in play. They include a warning about forward-looking statements, essentially saying that their future plans and predictions might not turn out as expected. It's a standard caution, but it highlights the uncertainties in their business. So what's the big picture here? JAKKS Pacific is facing some headwinds. Their sales are down, they're losing money, and their expenses seem to be growing. The drop in cash is particularly concerning, while the new credit facility offers some breathing room. The significant inventory increase and substantial royalty obligations suggest they're managing a tight ship with some potential challenges ahead. The decrease in net loss is progress, but it's from a very low starting point. The company really needs to see their sales rebound, especially in the costume segment, and manage their expenses more effectively. The industry is tough, and with big retailers like Walmart and Target being huge customers, any slip up in maintaining those relationships or adapting to changing consumer demand could hit them hard. Looking at the numbers, it seems like the company is trying to navigate a challenging retail environment. The increased selling, general and administrative expenses alongside a sales decline suggest they might be investing in future growth, but it's not paying off yet. The overall direction is concerning, and they'll need a strong turnaround in their sales performance and better cost management to really improve their financial health. Alright, that's our breakdown of JAKKS Pacific's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.